Welcome to Investing in the US podcast, a podcast where we talk each and every week about awesome things that we're investing here right in the US. It's talking to operators, different people about how we come about and show you, all you guys out there, our investors, what we're looking at. And today we're here with David Moghavem. David is the CIO of a vertically integrated company of Trion Properties, $1.5 billion in acquisitions. He leads the firm's investments and acquisition strategies nationwide with extensive expertise in sourcing, underwriting, and executing value-add multifamily investments across key US markets. And David is a frequent industry speaker and is known for his expertise in multifamily operations, capital markets, and multifamily or market cycle investing. So I'm really pumped and excited to have him on the show today to share his
Thank you.
incredible in-depth knowledge. But David, mate, we're in this incredible office.
Yes.
You just moved back. I'm sort of walked in here going, wow, what are we doing
This is
here?
a nice collab. It's the Deal Flow Friday
Yes.
collab with Reed Goossens, and we hit it off for lunch about a month ago. And we're like, "You have a pod? I have a pod. Let's cross
Let's
collaborate
do it.
and do a collab pod." So I'm
Yeah.
I'm glad you're here. And this is actually the first uh, pod we're doing in person in the LA office. So you're kind of the guinea pig, but we have a nice setup as you could see, and hope to do more of these.
I think it's getting in person. You can feel the
I
energy
know,
from
100%. It's way
somewhere else.
better. It's way better in person. I think it's nice to have the virtual so that you can talk to people and not just be limited geographically with
Yep.
like, oh, I'm only going to talk to people in LA.
That's right.
But the in-person touches goes miles deep.
I completely agree. Well, for our audience, then we can sort of cross. Tell us a little bit about the background of Tryon,
Sure.
David Moghaven. Like, what's the story? What's the elevator pitch?
Yeah. So Trion Properties, we're a multifamily owner and operator. We're vertically integrated. We have about $1.5 billion AUM, over 6,000 units. We actually just launched our third party management platform as well. So that's another vertical. So not just managing our own properties, but managing for other clients, which, as you know, in a market like this, management is key and all the cracks are starting to show. And we've been on top of it. We own in California, Oregon, Colorado. We have a deal in Dallas, and then we have Florida, Georgia, and Carolinas. We have about 1,500 active investors. Last year, we sent 2,200 K1s this tax year. So, as you can imagine, it's brain damage, but we've really fostered that investor base through cycles. We started in 2005. Max and Mitch built out a portfolio, sold it right before the downturn. Then, when the GFC hit, we started buying non performing notes and REOs collateralized by multifamily. Made a killing, which today is paying its benefits too, because we're starting to see some of that. We're actually like on foreclosure radar. We're starting to see the distress, and we could get into that. But when that market dried up and that strategy dried up, we started just getting into traditional value add multifamily. And well, I joined in 2015, and that's when we first broke into Oregon. And we were just in California. We started buying in the Bay Area. We've been owning in the East Bay for the past decade, which now we're just starting to see the renaissance of that. So we're excited with where we're positioned there. Broke into Oregon. Then in 2020, well, before COVID, we were trying to we were trying to break into Colorado. It was tough, very tough. We felt like the boat kind of sailed, but COVID hit, and that gave us a window of opportunity to buy our first deal in Colorado. And it's the biggest state we own in now.
Hmm.
Maybe fortunately or unfortunately, because it's also one of the worst performing MSAs in the country, but I still like it long term. Then COVID happened, and we saw how we were clearly too prone to the political risk in our markets because we were only in California, Oregon, and just broke into Colorado. We said we need some red states in our portfolio. So that's when we opened the Miami office. We started buying in Florida, Georgia, Carolinas, Dallas, and now we're diversified nationwide for the most part. And we overlap in some markets.
Yes.
And I think that's how we connected. We saw the deals that we were competing on, the deals that we've bought, and it's great. Honestly, it's great to share notes with another operator. People think with real estate, whoever's not in real estate, they think it's like super competitive um but the truth is like if you're trading notes with another operator, you go above and beyond.
That's right. That's right. No, no, and we did compete on a property in Dallas, a little while ago, and we now own it, right? And it's going okay, right?
Yeah,
And I think that to your point of trying to break into the Denver market, we've been trying to break into the Dallas market for a long time,
right.
and it was only this sort of post pandemic that has been that opportunity with a lot of pricing reset. Talk to me about how much of the portfolio is sort of call it West Coast blue states versus now red states. Like, how's that changed since you've joined?
Yeah, half and half for the most
Okay,
part, or maybe I would say like one third California, Oregon, one third Colorado, one third
elsewhere.
Southeast.
Gotcha,
Yeah,
gotcha. And what's your buy box today? Like, what are you seeing as opportunistic? You just mentioned like the company has a history in REOs and buying notes. What are you seeing today that's like really getting you jazzed?
yeah. We've always our mantra has always just been thinking outside of the box and being creative and trying to come up with some sort of edge or alpha, and really being 9 miles deep rather than 9 miles wide.
Hmm.
So that's part of the vertical integration. That's part of the buy box of the strategy we do. So traditionally value add multifamily, but we go much deeper than that depending on the market. And if you ask us today, we have very tailored strategies for every market that we're in.
Hmm.
Whether it's the Bay Area, we bought a lot in the East Bay 10 years ago when there was the app boom. We bought along the BART. We bought in the East Bay. And because deals in the city were trading at two cap, three caps in San Francisco, we're like, we can't buy that.
It's insane.
And so we would get more yield in the East Bay, and we would get renters that were commuting into the city, living in places like San Leandro, Hayward, Fremont, and got six-figure incomes, which at the time was very high 10 years ago. And we're getting those incomes in these workforce pockets of the East Bay because the BART was only a 30-minute commute
Mm.
into the city. We're seeing that play come back, and we're perfectly positioned for benefiting that play because we still own a good amount of assets in the East Bay, for instance. That's one of like the many plays we have in our different markets.
Yep.
And
Like it's a more transportation orientated design
right,
being as a backbone of these folks need to get in there. Yeah.
right. So that's like one angle. We might see in places like Colorado where we're zagging in management when others are zigging. People are getting out of management because of the tough landlord environment that the political environment is passing. And we're actually getting into doing more management because we've mastered it. We had to master it
Hmm.
for our own portfolio. So we're benefiting and getting management as a foot in the door to find some real distressed cap stack opportunities that also have operational distress and us being able to come in and turn it around. Talking to lenders, talking to other distressed operators, talking to a lot of brokers that are introducing us to clients that are looking for management. So these are different angles that even though we're spread geographically, every market has its own specific
Hmm.
strategy.
Hmm. How much on the property management side are you across the entire portfolio now, or just some segments of the portfolio as you look to build that business out?
Whole portfolio self managed.
Okay.
I think one
When
of
when did that transition happen?
yeah. So we when we broke into a market, we tried many different ways of breaking into a market and learned our lessons each way. And I guess like the high level of it is if you break into a market and you try to self manage on the first deal, you're gonna have a rude awakening,
Mhm.
and you also don't have the necessary scale to be performing at its best. But then if you third party on the first deal, you get a little bit of benefit from that, but you can't third party when you have scale at
No.
this point because no one's going to care as much as you. And if you have competence and you care, you that's the two factors for success. You need to have competence and care.
Mhm.
And so we have both. Not all third party managers have the care, they have the competence. And not every person who self manages has the competence, even though they care. And
Mhm.
so you need both. And we've built both along the ways.
Yep. Talk to me about how, we have it on our portfolio as well, like we'll call it the reset. I think when in 10 years' time, we'll look back at this time and say that the famous reset, right?
Yep.
This, I can't give it another name besides the fact that we have peaked in multifamily in 2022, some crazy prices. You mentioned cap rates in the Bay Area, like they went 2 or 3%, but there's cap rates in Dallas, in Charlotte, in Denver, in Austin, trading at sub 5 caps, right?
Right. For core. Yeah.
Yeah, for core, it may be at the peak in Phoenix.
Yeah.
Value add was trading there
Yeah.
because
That's
you
true. I
you
peaked.
you you
Yep.
s you everyone was betting on the come,
Hmm.
right? And so how have you navigated that in the last, call it, because we've been in, I feel like we've hit the bottom, but we've sort of been dragging along the bottom a little bit
Yeah.
where everyone's still talking about supply and, it's gonna dry up, and then it get to the next year, and there's another 20,000 units being built in whatever the city is. So how did you get through it or going through it? And 2, do you think is a good time to be buying right now?
Yeah. So I'll take a step back and say this. This is the first time in a long time that I'm seeing markets all trading at different yields
Mhm.
and all have different type of risk adjustment. And it's an exciting time for that reason because you as an operator can now give your pitch of why you like this market and why you think it's priced accordingly. Things being priced like before when rates were at zero during the ZERP era, everything was priced the same. Whether
Mm,
you were in the Sun Belt or you were in the Midwest, like everything was tight cap rates and everyone was chasing for yield. And tertiary market was trading the same as a core market and it didn't make sense. Now everything, as you said, with the big reset, everything is now trading differently. So what does that mean? It means you can now create different strategies for the different markets that you're looking into and having conviction in something that might be out of favor, like in Atlanta, and seeing how it has a better yield. And you can look at the supply demand story of that market. And so we're picking our spots right now because of that. We're picking markets uh, that we feel like have great supply demand fundamentals. Not every Sunbelt market is burdened with supply forever. There's some that are actually absorbing, like in Atlanta, for instance. But there are some Sunbelt markets that can't be absorbing the same way and still need more time. Um, but then we also like these West Coast supply constrained markets like a Bay Area or even a Oregon that didn't have the same construction boom that the Sun Belt had. So we're looking at the supply demand dynamics and kind of picking our spots based on that.
do you think interest rates come down this year or continue to expand?
Yeah, I don't know. This is January 16th. Uh Warsh is going to give his first Fed meeting tomorrow.
June 16th, right?
Oh, sorry. What did I say?
January.
January. Oh my
Yeah.
God. June 16th. Warsh is going to give his first Fed meeting tomorrow. And what's interesting is Trump announced his deal. No one's
Mm,
seen the deal yet. And you saw oil prices drop, but you saw treasuries
say hi.
stay
Mhm.
the same. And that was a bit of a head scratcher. You would think bonds would rally too, but they haven't. And why is that? I think the print CPI, it's still something that's really affecting treasuries and inflation really like makes, makes that sticky, makes the treasury sticky. And I think people are holding their breath right now for the Warsh meeting because that first meeting, he's about to lay out the land of the next 5 years of policy. So as we're talking right now on June 16th,
Mhm.
we might release this after the meeting and someone might be listening to this and saying, "What? Like treasuries aren't like there was a bond rally after he's like, or wow, treasuries spiked." Like we don't. I think everyone's holding their breath for this meeting. I
Yep.
think this meeting is gonna shake up the market. We'll see when this publishes if I was right or not.
Yeah.
It'll shake up the market, and we'll see if it's for good or for worse.
Well, I also think that there's probably a little bit more, the employment hasn't been as strong as we want, right?
Hmm.
I think there's a lot more pain than, like, if you look at the data, yes, there's good jobs, but they get think the last 24 months, it's been revised down every single month,
Yeah,
right? And you look at the sectors that are employing, it's government and medical, and maybe some AI. Like it's not widespread.
right,
It's more government jobs than it is private sector jobs. So like that's been going on for a period of time now. That hasn't just been, oh, this has been the last 6 months. Like it has been for probably the last 2 or 3 years. And so how when's that shoe going to drop? Like you and I both rent to workforce housing folks. And I know back in after the stimulus check turned off, like rents just created overnight. And to this day, like delinquency is still a problem. You know, putting food on the table is still an issue. Gas prices are still high. It doesn't necessarily mean that we're all feeling hunky dory. You know,
right.
with one meeting
Yeah,
that's going to come out. Like it's, I think there's still some ongoing issues that and just you can list out since 2020 the things that have happened. 2020, obviously, stimulus, interest rates, COVID money, tariffs, now a war. Like it's kind of like we keep getting punched. If that
right.
makes sense. And I think the wider economy is you can sort of dress it up as you want, but it doesn't feel like it's not. It doesn't feel rosy. It doesn't feel great.
I totally agree. And it doesn't get talked about enough how everyone's talking about cap stack distress, and not as many people in multifamily have really addressed the operational distress, because
Hmm.
to this point, there have been cracks, but it hasn't been widespread unemployment or anything. Thank God, knock on wood, like that would really be tough to operate in. But we got to prepare. We got to prepare for that, because I think what you're seeing now from an operational standpoint is the cracks are just going to start to widen a bit. And once there's operational distress, you're going to start seeing more of the capitulation, more of the cap stack distress turning into sales, more of the lenders saying, okay, we need to move on.
Hmm.
The reason there hasn't been so many sales from this cap stack distress is because lenders have more optimism in tomorrow than they do with today. The operations will get better tomorrow than today. Once we start to see the operational distress, that's when you're going to start to see, hey, I need to get my hands rid of this and we need to move on.
Yep.
So that light at the end of the tunnel that everyone talks about is what's keeping lenders for holding on, operators holding on, kicking the can, the extend and pretend, all these buzzwords you hear is because of the optimism tomorrow relative to today. Once that changes, we're going to see something else.
I think that that's the thing I'm getting at. Like, how many times have you been in MHC and it's like, this is the year, this is the year,
Yeah.
this year's like, we went this year's a fourth, excuse my language, fourth fucking year I've heard that like people are like, it's going to happen, it's going to
Yeah.
happen. It's like, and I thought personally that like we get to the end of 24, that was the bottom, right,
Right.
of rents distress in certain markets. And 25 hit, immigration, ICE policies definitely have hurt us, and hasn't come out in the data. Um, but I don't know what changes it. Like either like it's kind of like at the point, like have the freaking recession move. Like let's just have it at this point. Like
Yeah.
what are
Just
we
it's like a
waiting?
band-aid, just rip
Yeah,
it
yeah, yeah,
off.
yeah. And I get on the other side, like banks have learnt from '08, right?
Mhm.
They've learnt their lessons, and they're trying to avoid a run on the banks, and they're trying to have avoid a systematic collapse. But at some point, we're just dragging along the bottom, and I don't see massive flight back to sort of maybe rent growth or whatever that might be in the near future.
Yeah.
Again, back to end of 24, I was like, oh, we made it. We got to 25, and we can tell that. But then there was sort of then rents create a little bit more depending on the market you're in. So it's tough. And then on the other side, when you look at the treasury, the 10-year, it's still in the 450s. Like,
Right.
and I'm not grey in the hair, but I know that things that doesn't get closer to 4, and we have seen it in the 5-year where it dropped below 4, and all of a sudden you started to see stuff started to happen again, and then jump back up and like, oh fuck,
It's
and so the longer we're not at or around 4 on the 10-year, the less deal making
exactly.
territory we're in.
Four on the 10-year, 3.5 on the 5-year is like the sweet spot
Yep,
right now for
deal
buyers
making.
and sellers coming
Mhm.
together
Yep,
and making shit happen.
and we've seen
That's
glimpses of it.
finger in the air.
Yeah,
Like
yeah.
that's where it is. We need 3.5 on the 5-year, 4 on the 10-year. We need some sort of green shoots so that when you have a deal under contract, let's say, the rent roll isn't deteriorating. It's only getting better, or at least, getting neutral trade outs,
Yep.
which I don't know if we're going to necessarily see that with what we're just talking about, but we can at least get the 10-year and the 5-year, which it's shocking to me because you would believe the government has the power to dictate the markets to where treasuries can be at that level. And I'm sure it's their mandate to do whatever they can to do it, but they haven't. And it's something to be said of where markets are today, that despite everything the government's trying to do to get treasuries to where they need to be to combat inflation, you still have a sticky treasury above
Well,
where we need it to be.
and I think that again, we're not both not economists, but like that is a canary in the coal mine that I think investors are still saying, like to your point, like when that quote unquote deal came out the other day, it didn't bounce
Yeah.
because people are still worried about. We've heard the word transitory inflation. Like this war and the Hormuz thing is it's going to take time to play out. It's not just like
Hmm.
tomorrow it opens up
Right.
and oil's flowing through and
Right.
gas prices are down again. It takes time. And so I think that's could be the market saying, well, we're pausing here. Let's
Yeah.
see what the actual details are. And because even if tomorrow, if Hormuz and the war was over, there's going to be a lag effect.
Yeah.
And so I think that lag effect pushes us into
It's
2027.
it's interesting though, because the equity markets, if you look at the stock market, it's already pricing in that that the war is going to be over or is over. So it is a bit of a head scratcher, and I think it comes down to like inflation and maybe the Fed meeting, and maybe if Warsh gives some sort of signaling, where yes, he pauses tomorrow, but he's signaling some sort of cut or some sort of hawkish outlook, we can see a bond rally. So we need it. We're praying for it. We'll see. What does this mean? Coming back to real estate, what does this mean to value add multifamily in the Sun Belt? I think for me, in general, it's buying based on what it is today. And pre rate hike, everything Trion would look at our North Star is untrended yield on cost. Is what do
Mhm.
you think the property is going to become? Not what it is today, but what is it going to become after spending the dollars renovating the kitchens, after getting the upside in rents. Now, what we're focused on is day one yield net of cost, which is deferred cost, net of gain to lease, net of the expected deterioration of the rent roll. So that is like our North Star today. And if you can be positive leverage, you could be cash flowing, you could be at least 5-6% cash on cash going in, net of the deferred maintenance that you have to spend on a 70s deal, or net of the gain to lease you might have to see on newly uh, re-
You trade outs.
a new trade out deal. So um, that is what we're seeing. And when rates are 5.5, could be 6% even at some point without a buy down, and you want to get to positive leverage, next side,
That's not going to happen.
that's not going to happen in
No,
multi.
no.
So that's what's tough right now.
And for us, if we just bought a deal in Fayetteville, North Carolina, right? It's a
Hmm.
big military town. It's a small town.
We own there.
And
Yeah.
you
Yeah.
own there, like, and we bought 6.1% cap rate. We got a just over 5, I think 503, and positive leverage day one. And it's still hard with retail investors to get them on board
Hmm.
because they want the new vintage, they want the positive leverage, they want the 9-foot ceilings, but they want it in Dallas. It's like, well, you're not going to get that in Dallas, right?
Yeah.
You're not going to get that in Denver. You're not going to get that in, Charlotte. And so you have to venture to these markets. But even when you produce all of that for an investor, investors are still, at least on the retail side, they're licking their wounds. There's a lot of blood in the street right now,
Yeah.
and deals have been handed back, and people have been whacked, and it's hard to have that conversation with someone saying, "Hey, oh, sorry, you got whacked, but trust me, this time's a good time," right? And it is a good time, I believe, to be buying it. Just trying to when their stock portfolio is up 25%, you're like, yeah, it's hard.
Yeah. I
It's
mean,
hard.
the combination of how the S&P and stocks are performing, the sexy IPOs coming out right now, combined with retail investors getting burned, whoever invested in 2021, 22, not really understanding it's a cyclical market, not understanding the risk profile of the assets they were investing in, it's tough to get some of these retail investors back into the table. For Trion, we're lucky because we have investors who have invested with us through cycles. And that's important because you need investors in the stable that see that this is a cyclical time where, as you said, at the bottom, does that mean you have to buy things speculative? No, but it means you buy things with good going in yield, which is what I was referring to, the day one yield net of deferred, net of gain to lease, that you feel that the deals can stand on their own 2 feet.
Hmm.
And we're starting to see that in good markets. Maybe it's not the sexiest markets, but we're seeing that in good tier one MSAs that we're in today.
Yep. No, and I think that goes back to just looking at the data. And I know when we pitch our investors, like the 2022 pricing is a data point. It might be a blip. You know,
Yeah,
you're going to have this sort of trend going up and to the right, and it'll have this little bump where in 2022 from valuation, but you can still measure to it, right? If you
right,
can measure to the data and say, hey, look, we're picking this thing up at a 30 or 40% discount to similar vintage assets that's sold in the peak, I have been getting some pushback from my investors, but I think it's still a defendable angle to come at to say, like, do we get back there? Maybe not.
right.
But if you've got the positive leverage, you're conservative enough on at least on rent growth for the next couple of years, and you sort of put a long enough term on the debt, because I think that's the other big thing, the cap stack to what we've talked about before is the cap stack distressing. I don't know about you guys, but we're only been executing Fannie and Freddie
Yeah,
agency on a 5 or 7 year
right.
to avoid that and to show our investors like, look, we don't do anything from day one. It's still going to cash flow. It's still
Yeah.
going to have a
And
heartbeat.
by the way, that's old school real
Right.
estate, OG investing.
Right.
That's like how real estate has been and quite frankly supposed to be.
Right.
Real estate, this 3 to 5 year hold, which Trion's guilty of doing. We would do 3 year bridge loans and we would make a lot of money doing it. But is that really what real estate is supposed to be? To
No.
me, I feel like real estate's a vehicle where you get incredible tax benefits, depreciation, you have great appreciation. It's a hedge towards inflation. And to me, that cash flow with those tax advantages and being able to hold and build wealth is really what real estate's all about.
Mhm.
If you want to get rich quick, there's many other ways to do it in this world
Go
than just do 3 year flips of real estate. I think the beauty of real estate is the 5 to 7 to 10 year plus holds that you get, the cost segregation, the depreciation, tax benefits. These vehicles are incredible that we don't take enough advantage of if you're only doing a shorter term hold.
That's right. No, I completely agree, and there's ebbs and flows of all that as well, because you can get too aggressive on the cost seg in early years
Yeah.
and then become negative in your not your cap stack, but in your capital account. So, but coming to sort of the end of the show, like, what's making you most optimistic in the next 6 to 12 months right now at Trion?
Yeah, honestly, I hate to bring up the AI buzzword because my last 2 episodes have been AI, AI. I saw a commercial the other day where it was just like AI, 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 and it's starting to get a little nauseating. But that said, I'm the de facto head of AI right now for Trion, and everyone in the office will agree. And we're all on Claude. We're all on. We've completely transformed our workflows, and we're not only insanely more productive, but we're actually reaching this next phase of data
Mhm.
synchronization and
Mhm.
synthesis, where we're starting to come up with real investment theses with the data that we have sitting in our computers, in our cloud. Trion's really well positioned for that because if you talk to a lot of groups that are institutional, they haven't given the keys yet to let AI do its work and magic to do it for good reason, obviously with privacy. And then if you're a small group, it's tough to break into the institutional space with where capital markets are at. Tryon, we've broken into the institutional space, but we have the means to be nimble, to leverage AI, connect it with all the underwritings we've done, the thousands of underwritings we've done. We have a whole CRM system that we've been tracking deals for years. We've integrated that, taken the API, built our own MCP, connected it to Claude, have that connecting to our Outlook, connecting to granola meeting notes, and all of it just meshing together, marrying each other, and creating this great not only workflow but investment thesis of like or approach on how we can use AI and data to see things that something in CoStar can't tell you, or a manual phone call won't be as productive enough. So that's what's getting me excited the next 6 to 12 months is kind of using AI and taking what we have to the next level.
Yeah, I completely agree. And just to on that, you also within that workflow that I'm sure you're building out, you're sort of finding inefficiencies that a barrier to entry to create your own software or own process
Hmm.
would require multiple six figures to hire a developer, where it's now becoming a lot less.
Yeah. The
And
barriers to entry are much lower. And I think that's also what gets overlooked when people talk about the economy and jobs, not discrediting what we've already talked about. On the operational side, I see that coming. But I also do see the pie getting bigger.
mm,
The fact that we can now spend a few $1,000s on creating this custom tool for lead gen, which is what we're doing for third party management. We're using like a custom lead generation tool that we're building that this would have cost six figures easily,
yep.
easily. And now it's replacing six-figure jobs. But now we're able to source more business. The pie is going to get bigger. And I think that's an exciting time. The timing of it, no one knows whether it's going to be a pro or a con, but the pie is getting bigger for sure.
No, I completely love it. Last question: where can people reach you to continue the conversation? That'll be in your sphere. Where do they go?
I'm here at PDC, Pacific Design Center in LA, Green Building. If you want to come in person, come on Deal Flow Friday as well.
That's awesome.
No, I'm on LinkedIn, Deal Flow Friday. We're on every podcast streaming app as well. Uh, I mean, it's there's so many avenues to come talk to me, and you could even come join Reed and I for another lunch meeting in Culver City because Reed's got some good spots there too. So
Well, mate, look, want to thank you for jumping on the show, inviting us into his awesome studio, just and opening up and being pretty transparent about where you guys are at, and the good and the bad that
right,
will all come through, and some of the cool things you're doing in the future. So, I'm excited to see you guys continue to grow, and like we all are, and just want to be a resource as best we can. So, thanks
thanks
for
Reed.
coming on
Thanks
the show.
for driving up Robertson to come up here and. The traffic's never easy, but it was great having you on as well. And looking forward to finding ways to work together.
Awesome.
Awesome.
Well, there you have another cracking episode, jam packed with some incredible advice. If you do want to check this show out, please give it a 5-star review on iTunes. If you do like it, share it with a friend or a colleague because we like to spread the word. And we're going to do it all again next week. So remember, be bold, be brave, and go give life a crack.
Amen.